How much do you expect your investments to return for you each and every year or for the future? You've got to be careful that your expectations are realistic and they're not too high. I've got 3 consequences. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. How much do you expect your investments to return for you each year or out there in the future? I would ascertain that by looking at, well, how much has the overall stock market done throughout history? What's throughout history, the average kind of valuation, price to earnings ratio, forward PE, whatever. And then where are we today? And I would have that sort of start setting my expectations of what my stock or my US stock-based investments should perform. But then I would look and say, well, am I diversified? How much risk am I taking? And therefore adapt that expectation, based on historical perspective and evidence, adapt that expectation of a future return based on that information. Okay, that's not the point of this video. I'm just sharing a little bit of how I would approach it and how I approach it with clients. But here's the issue. Take a look at this headline. Apparently, when studied, financial advisors, their clients have expectations that their investments are going to return on average 17.5% a year. I mean, guys, that is an outrageous number. History does not support that expectation, and shame on any advisor for either encouraging that or setting anything close to that as the expectation. Really, your financial advisor should be coaching you and showing, hey, this is historically what the markets have done, and with your diversification level, you're taking this level of risk. Therefore, we'd hope that, a future return on average should be this. It's certainly not going to happen every year. But my goodness, 17.5% future returns from here, that is staggering. Now, you might think, well, wait, that's not normal? And no, it's not, okay? But the other thing you might think is, okay, so who cares? Who cares? What are they just going to get their feelings hurt when that doesn't happen? It's not that big a deal. No, there are some big consequences if you have poor expectations or unrealistic expectations of what your investments could return. There's 3 significant consequences that we've seen as certified financial planners when folks come in and have too lofty of expectations for their investments. They can make these 3 critical errors. Number 1, especially if you're assuming an average return of 17.5% per year from here on out, when you inevitably don't achieve that, you will likely make some significant changes at likely the wrong time, okay? If your expectation is that I'm going to be able to double the performance of the stock market, well, when times are good, you're probably going to say, yeah, well, we're getting close, but hopefully next year. But when times are bad, that's likely when you're going to say, what, you weren't able to deliver that at all, or these expectations you weren't able to meet, and I'm going to make a change at precisely the wrong time. So having unrealistic expectations about what your investments should perform is going to lead you to making more changes than you probably should, and changes at typically the wrong time. Now, I've heard some folks talk about investing too much is like a bar of soap, okay? You touch the soap too much and it eventually will disappear. And your investments are the same way, basically as a suggestion that, listen, don't tinker with your investments too much. Now, I would say don't tinker with your overall investment philosophy, your overall investment strategy. I've talked before about people having, there's 3 different types of investors. You're a trader, and so you're working some sort of daily or weekly trading strategy. You're a long-term investor, okay? Or you're a saver, and therefore you should have very little invested in the first place. So when people have identity crisis there, that's what leads them to kind of, touch that bar of soap too many times, and eventually they'll shrink their portfolio because of it. So too lofty of expectations for your investments could lead you to make too many changes or changes at the wrong time. But what else could it do? It could lead you to saying, well, I don't need to save as much for retirement. Trust me, if you're trying to reach a long-term financial goal, Typically, that means saving up for retirement. But what if it means saving up for your kids' college, or saving up to, to take a trip, or saving up to start your own business, or something like that? One of your inputs, one of your projections is going to be, what do I think my investments will return for me? How much growth do I think I'll have? And if you put in there, if you use an assumption that, well, it's going to, 17.5%, or a large expectation, the output's going to be, well, you don't need to save that much. You only need to save this. All these guys saying that you need to start saving 15% towards retirement from your very first paycheck, oh, they're crazy, because, I can just return. I'll have returns higher than well above the average, or what would be realistic, and therefore I don't need to save nearly as much. There's danger in that, right? Because what if you aren't able to achieve that lofty expected return? Well, guys, the way to build wealth, the formula for building wealth is cash. So, how much are you contributing? Plus risk. So how much return can you get? Plus time. And if you think I'm going to be able to get a lot of return on my cash, therefore you're going to waste a lot of time hoping that turns out to be the case. And if it doesn't, it's going to be hard for you to make up that time. So second big risk with having too lofty of investment expectations is you might underfund your goals. All right, and then the final risk, the final issue with having too lofty of expectations, or thinking your investments will perform well above what's reasonable, is it could lead you to take too much risk. It really could. We talk about all the time. We talk about the risk that you're taking in your investments needs to be consistent with your overall financial plan. And that is, the goals that you're saving up for needs to be consistent for that. You're not taking risk just for risk's sake. It needs to fit. And then also it needs to fit your risk tolerance and your time horizon. You've got to be comfortable. Now, no one likes to see their investments going down. No one does. But you've got to be comfortable with the strategies that you're using, and that you're able to ride through the inevitable bad times so that you can take advantage of those good times. The issue is, in order to achieve, there is a risk-reward relationship, correlation. So in order to achieve very, very lofty returns, you need to take a lot of risk. And what you introduce is something called non-systemic risk, where you might be taking some significant risk that you might not be rewarded for, because it's more of a gamble as opposed to a long-term proven strategy. And when that happens, your retirement or your goal achievement starts to become a zero-sum game, as opposed to I'm just accumulating wealth and building wealth. It's either going to work because it's going to pay off. You've taken this significant amount of risk and you've rolled the dice and it's worked, or it's not going to amount to much, or you're going to lose a significant amount and therefore won't be able to achieve that goal. So I think having too high of expectations will lead you to take on more risk than maybe is appropriate for your overall financial plan or your risk tolerance and comfort level. So what do I suggest? Do I suggest don't have any expectations? No, you've got to understand what your overall investment philosophy is and what the strategies are that you're using to achieve that philosophy, okay? From there, and in that discussion, there should be some sort of expectations that, listen, the stock market your investments should have this sort of relationship with either the stock market's return or with your future return expectations. Here's what you should be expecting for the amount of risk and the strategies that we're using. But there is danger in assuming that you'll be able to achieve, to me, what sparked all this was 17.5% rate of return. That certainly is possible in a vacuum, in a small period of time, but it shouldn't be what's expected over the long term, okay? The U.S. stock market, has averaged somewhere around 10% per year over a long period of time, but it's not going to do that each and every year. It did almost 90% over the previous 3 years. That far exceeds 10% a year, and therefore that could be one of the reasons why we're seeing some sort of contraction, okay? So to assume a 17.5% rate of return has some significant consequences. Work with your certified financial planner, avoid those consequences, make sure you avoid those investment mistakes, and make sure you're taking the right level of risk and the right strategies in your investments to meet your overall financial goals. If you don't have a CFP that can help you with that, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247 5898. All right, there you have it. Go out and take your next wise step in your financial life.